So when you die, I don't like that word, when you graduate and go on to a better place, what happens to the banking part, the cash value of your IBC policy? I get asked this all the time. Basically, what exactly happens on graduation day is they're asking. Because we teach to use a specially designed whole life as a banking policy, which means there's going to be a death benefit, but we're always going to be borrowing against our death benefit. So a lot of people think there's not going to be any death benefit that's paid out when we die because we're always using that, but that simply isn't the case. The death benefit is paid out to your beneficiaries, but let's define the death benefit. What makes up your death benefit? So the first thing that makes up your death benefit is, it's called the face amount. The death benefit is just part of the contract. Now, when we build an IBC policy, we're going to make the death benefit the lowest part of the policy. So we're going to put the lowest death benefit on so that the costs are the lowest. But the best part about the death benefit in an IBC policy is because we're dumping so much money into the premium deposits, you can never ever have more cash value than you do death benefits. So because of that, your death benefit is going to organically grow. So although your death benefit might be low on day one, over time, when you're using the policy and investing the money and lending it out and doing all the things you're going to do, that death benefit just keeps going up.
It's going up. It's going up!
Which is a really great thing for your family and for your legacy plan. The second thing to understand is unpaid loan balances. So if you remember, when we take loans from the policies, we're taking a loan against our death benefit, which means every loan decreases the death benefit. So therefore, when we graduate, any unpaid loans and unpaid loan interest is subtracted from your death benefit. So whatever your loan balance is subtracted away from your death benefit. So when you graduate with loans, the death benefit will be paid out, but it will be the net amount. Now, a lot of people get freaked out about that. They're like, oh my God, it's not going to be enough. Hold on. Because the third thing I want to explain is as your cash value goes up, your death benefit goes up. Because like I said earlier, your cash value can never, ever exceed your death benefit. So think of it like this. Your death benefit starts up here, but your cash value starts to grow. So if your cash value kept growing and your death benefit remained level, your cash value would exceed your death benefit. That can't happen. As your cash value grows, and we put money into the paid up additions rider, which is how we build these, not to get technical, every time we put money into the paid up additions rider, your death benefit goes up. Cash value goes up, death benefit goes up. Cash value up, death benefit up. So over time, your death benefit starts compounding very quickly, just like your cash value starts compounding. The two work simultaneously, not dollar for dollar, but simultaneously. That brings me to the fourth thing. You don't have to pay taxes on the death benefit. Well, you'll be gone, you'll be on to a better place, but your beneficiaries, which could be your children, could be your spouse, could be a charity, could be a trust, there's going to be no taxes on that death benefit. So, if the death benefit is passed on tax-free, that gives a whole different element to this whole thing. Now, I know when we build these infinite banking policies, we're always focused on the cash value, the banking aspect, the sexy thing, the access and the control of the money, but there's a whole other story to be told. You see, I've been in this business over 20 years, which means, unfortunately, I've had to watch many of my clients graduate. And when they do graduate, obviously, we hear from their family members, the beneficiaries. They call us up and say, you know, so-and-so has passed on. They're usually pretty upset. And it's hard for me, too, because I get close to my clients. But there's one that was extra hard. It was one of my first clients. Gave me my shot as an advisor. He was my first big client. And I'll never forget, I did everything for him. I did his retirement. I did his life insurance planning. And that day came when he fell ill. I went to his house and I saw him. He could barely get out of the chair. And he just sat me down and he said, Chris, I just want to make sure everything's okay for my wife. I want to make sure she never has to worry about anything again. We went through all of his numbers. We went through all the benefits and the death benefits and everything, and we found out she was going to be just fine. And he just smiled. And then I got that call. I got the call that he had passed away, and I'll never forget that day. See, we get a check from the insurance company for the death benefit, and we deliver this check to the family. And when I went to that door, I knew in my heart that everything that my client wanted was going to basically be fulfilled right here, but it was his legacy. And when I handed her the check, she had no idea As many wives, for some reason, they don't handle the money in the household, so therefore they don't really know. They're nervous. Like, how am I going to keep the house? How am I going to keep the car? How am I going to maintain this standard of living? But when I handed the check to her, I said one thing. I said, your husband wanted me to tell you that everything's going to be okay. And when I gave her the check, she just started crying even more than she was. She finally knew that he was there for her, and he took care of her. Folks, listen, I know it's so great to provide cash, and we're going to get all the money back for all the cars we're ever going to buy, drive, and own, but let's also sometimes think about what happens when we're not here. What is the benefit? What is the value of that? Those tears, that realization that everything was going to be okay because he changed one thing, and that's where his money went first. So let's dive a little bit deeper into this. Since your cash value can never exceed your death benefit, let's just talk about the way I was taught this. So those paid up additions, okay, which is the rider that we use to put the majority of the premium deposit into, because that's the money that can be used, that's the money that helps the early cash value, and that's the money that allows you to take money out of your policy immediately in the first 30 days. So every dollar, here's how you got to think of it. Every dollar that goes into the paid up additions rider, essentially what it's doing is it's buying a micro, mini, little whole life policy, which has cash value, which then pays dividends, and death benefit. So every dollar that goes in is buying another one of these little policies. So every dollar that goes in, your cash value goes up, and because it's a little policy, the death benefit goes up. I remember being shown this, and I remember the training manager drawing this on paper. He said, so here's your policy, here's your death benefit. Every dollar that goes into the paid up additions buys this little policy. And this little policy works just like the big one. It's got cash value and death benefit. And the cash value goes on to earn dividends just like the big policy does. And the death benefit just gets added to the overall death benefit. That just made sense to me. I don't know if that makes a ton of sense to you, but sometimes the visual aspect of it really helps you to put it together. So let me give you another story. It doesn't have a happy ending like this one. So this and this happens altogether too often, and it really bothers me. But we'll get a call from a client that sees our video, sees one of these YouTube videos, and they get really excited about starting their infinite banking journey. And then we get them on the phone, and a lot of times it's engineers or very analytical individuals that want to dive deep into every aspect of it. They start dissecting all the numbers. They start running their own spreadsheets and doing all this. And eventually, like, what was a great, exciting thing for them now becomes something complicated because they've made it complicated. And they put it off. Oh, I'm gonna keep reviewing this and researching this, but I don't think I'm gonna move forward. For us, that's fine. We only want to work with people that want our help. There's a lot of people out there that need help. But just recently, we had an individual who we met with 2 years ago. Perfect candidate for the IBC concept. Had lots of ways to move money, had disposable savings that they could redeploy and change where that money goes first, but just got so in their own head about the policy and the illustration, which is the least important part of this entire thing. Because with the infinite banking concept, I want to be very clear. The infinite banking concept is a process, not a product. Everybody makes the infinite banking concept all about the whole life. And this person just focused on the product. The product is just a machine that we run money through. And we run money through a specially designed whole life for one reason and one reason only. It's the only vehicle that allows us to earn uninterrupted compound interest. Allows us to save and spend money at the exact same time. So what happened with this client? 2 years went by. He kept watching our videos. We call it, he stayed around the campfire. And he called us back up. And he says, you know what? I've really been watching these videos. It's starting to make more sense. I'd love to do this. We said, great, Mr. Client. Let's get this going. As soon as he got in underwriting, we found out that he had some medical complications. Nothing crazy, but just enough where he wasn't insurable anymore. I want you to think about that. Something that he waited 2 years for, that he could have done, now is gone forever. He'll never be able to start the infinite banking concept. He'll never be able to have a policy, and he'll never be able to protect his family because he waited too long. Why do we put off things? Why do we overthink things? When something's right for you that solves a problem you have, why do we try to find reasons to not do it? I'll tell you the number one reason. And the number one reason for this client was cost. He was so focused on the cost of the term rider and so focused on the upfront costs that came along with the policy. Why is it that I put this much in and I only have 75% available to use immediately? Well, that was his policy. Some of them are as much as 90. He just couldn't wrap his head around that. And I kept saying to him, I said, "Do you ever start a business?" "Oh, sure, of course." "Did your business make money the first year?" "Nope." "Second year?" "Nope." "Third year?" "Nope." Isn't that no different here? For the first couple of years, you don't make money, but you have access to the money to go make money elsewhere, but your policy doesn't make money. But then, after year 3, for the rest of your life, you're making money. Every dollar he would have put into that policy would have turned out to be more than $1 out. Later, after year 10, every dollar he put in turns into $2, and then every dollar he puts in turns into $3. Imagine that, a place where you can put $1 and then take out 3. Is that not a good place? Is that not something you'd want? And what if every day for the rest of your life, the money you put in, you could take out more, and every day it went up? It's a pretty cool place. But then I bring the bad news to you and I say, yep, that can happen for everybody and it's guaranteed. But for the first 3 years, you're not going to have access to all of your money. If you allow those first 3 years to be the reason why you don't do something that benefits you for the rest of your life, then shame on you. And for this individual, the shame on him is that ability for him to do this is gone. Nothing that was in his power, our health, is something fragile. We can't control it. Things can happen overnight. Things can happen immediately. You can get hit broadside by another car and now all of a sudden either game over or you're permanently injured and you can never get life insurance again. So that story I told you where that family was all taken care of will never be the story of this second individual because he allowed cost to get in the way of what would have been the biggest value of his life. I want you to stop and think for 1 second. I want you to think about this. Cost is only an issue in the absence of value. What was the value that that client gave up because of the cost in the first 3 years? Don't let that be you, folks. I hope you enjoyed this video. I hope it gets you to take action and get out of your head. My name's Chris Naugle, and I'm here to teach you how to be your own bank. If you like this video, check this one out. This video shows you how I lost $534,000 using the infinite banking concept. But if you think I actually lost money using the infinite banking concept, you don't know me. So watch the video to see me unveil the curtains to show you what no other advisor or agent wants you to know. I hope you enjoyed it. See you on the next one.